This is the Amplify ETF's quarterly update for the Amplify CWP Enhanced Dividend Income ETF, symbol DIVO. I'm speaking with portfolio manager Kevin Simpson. Kevin, thanks for coming back on. Let's talk about the first quarter.
Thanks for having me, Jay. And what a difference a year makes, huh?
Yeah, without a doubt. So before we get into the specifics of what you saw in the first quarter, could you give viewers a little bit of a reminder on what the DIVO investment strategy entails?
Yeah, absolutely, Jay. DIVO uniquely is so well positioned for where we are today, and I think where we're headed. And I know we'll get into that in today's commentary, but DIVO is a total return strategy. It's a core portfolio, 25 to 30 best of breed large cap companies, all of whom not only pay dividends, but have a tremendous history of dividend growth, which I think is maybe the most important part of the strategy that we'll talk about. In addition to that, we also use covered call writing in a tactical way to harvest volatility. And gosh, isn't there more volatility here in Q1 than we've seen maybe for most of the past 3 years? When you take the combination of the dividends, remembering the dividend growth component, in addition to the covered call writing, which we tend to be much more active in periods of volatility, we're really looking at a strategy that's going to be delivering somewhere in the neighborhood of 4 to 7% cash flow. Generally, it's going to be on the higher side when we see volatility. So an equity income portfolio with a growing income stream, and very, very well positioned uniquely in this environment.
So Kevin, I tell you, inflation is top of mind for financial advisors today. How could covered call writing help or hurt a portfolio in a period of higher inflation?
Yeah, I mean, that's the million-dollar question, Jay. Inflation is the issue. It's not transitory. It's going to be here for a long time. And how do investors keep pace with inflation? Specific to your question, the covered call component is really unique because generally when you have higher inflation, you would expect there to be more volatility in the market. I know it's a short sample size Q1, but boy, it proves that thesis correct. And if you have higher volatility, we're going to be generating greater premiums. I've always said that covered calls work best when we need them to most, which is in periods of higher volatility. So with an inflationary environment, if we expect more volatility, not only do we think that we'll be seeing opportunities to write a lot more covered calls, but also those premiums will be richer and more robust. So covered call writing is absolutely a technique that can be very, very well implemented in periods of higher inflation.
So Kevin, as we look at the Fed today, there are folks who believe they're going to become incredibly hawkish. There are folks who believe that they'll raise a little bit and then significantly have to cut back as the stock market may struggle in that environment. How does DIVO position itself in this environment?
Well, I think, again, we're just very uniquely well positioned in this type of environment. I'm in the camp that the Fed needs to be very aggressive in tightening, mostly because they've been so far behind the 8 ball. And that's not a criticism. I would always rather a Fed that's going to be more reactive than proactive. And the best thing about this Fed is the fact that they will telegraph everything that they're doing. It's like elementary school. They tell us once, they tell us twice, they tell us 3 times. And I think that's really an excellent approach because it takes away the shock factor. Now, the fact that we're going to be seeing 11 quarter-point rate hikes or several half a basis point rate hikes, I think that all of those things combined are really taking us only from a 0 Fed funds rate to eventually a 2.75 Fed funds rate. And I firmly believe that they'll raise it 50 basis points at the next meeting. But again, that still takes it from 2.5 to 0.75. All along this trajectory, it's still very inexpensive money, relatively speaking, over history. Now, getting rid of the balance sheet, that's a whole nother hawkish development that's relatively new to the conversation. All of these things are an attempt to bring down inflation, which is a very difficult task. And it doesn't always work. There's certainly no guarantee that it'll work this time. You hear about a soft landing, you hope for it, you cross your fingers, but it'll be a very, very difficult road for them to navigate a soft landing. And I'm not sure they can.
So Kevin, how does the dividend growth component of your strategy play in here?
Yeah, and I think this still also ties in your previous question, so I can kind of sort of leverage both in this answer. The dividend growth is really the secret to an inflationary hedge. when we think about inflation, the textbook is, hey, let's go to commodities or real estate or raw land or even energy, which is often an effective hedge. But at this point, those trades have gone pretty high. Not to say that they're over, because they're not. But what can we do in an inflationary environment for financial advisors who deal with regular people who are going to be in retirement for a really long time, looking at the costs of things escalating exponentially, supermarket costs, gasoline costs, housing? What I believe is the best part about DIVO for the foreseeable future is the fact that every company we own has a history of increasing dividends. So it's like getting a raise each and every year for every stock that we have in the portfolio. Whether the market goes up, down, or sideways, Jay, we're not only going to get paid while we wait for times to improve, but we're going to generate a greater income stream and essentially look at these companies as paying us and generating a raise in our cash flow. And that's not something you and I have talked about in the past 5 years as a highlight, because who needed it? The past 5 years, the stock market just went up. You didn't have to do anything. Close your eyes, throw a dart, what have you. It's a different world. And I think it's the dividend growth component that may be the most beneficial aspect of how we run DIVO.
That gives us a great opportunity to transition. Kevin, when you look back on the first quarter, what changes happened in the DIVO portfolio?
Yeah, I mean, the first quarter was an incredibly volatile quarter. I don't mean that as an understatement or as a flippant comment, but we lightened up on some of the technology names at the very start of the year. One of the rules within DIVO is if we have a position that grows to a 7 or 8% weighting, our target allocation is 5% per position. So it gave us an opportunity to trim Microsoft and to trim Apple, not to abandon the positions, but to take a little profits when things are higher. You never lose money taking a profit, and heck, that's not a bad philosophy for any ETF or any strategy. We also had Chevron and Marathon Petroleum, which were benefiting from the energy trades increasing. And one of our positions that was a real stellar trade was Newmont Mining. Newmont Mining is a gold mining company. Gold, as commodities were rising in this inflationary environment, really took off. So we generated a nice dividend on it. We owned it at about $59 to $60 per share. We collected really good premium on it, somewhere between $1.50 to $2. Ultimately, the position did get called at 70. I know that it's gone higher from there. One of the things that we have to face as covered call writers is sometimes we sell things into strength and potentially miss and forfeit a little bit of that opportunistic upside. But there's no, there's no shame in that trade. And again, reiterating that comment that you never lose money taking a profit, it's allowed us to recycle into some other positions that we feel can continue to benefit from this current environment. And I'll just give you 2 examples, Jay, real quickly. One is the Intercontinental Exchange. It's a stock market, a commodities market. Generally speaking, you'd see that have greater volatility and greater volume when commodities are hot. Well, that works and bodes well for an exchange. So we own a company that's benefiting from the commodity play. It has a history over the past 5 years, including this year, which it did in 2022, of increasing its dividend by 15% per year. Goes back to that raise that we're talking about. So that's a new position that I think is really opportunistic. And the other one is an old-fashioned company that we're really excited about. And I say that sort of jokingly because it's John Deere. We've owned it before. We cycled out of Caterpillar, shifted into Deere. It's been a really good trade for us as of late. And if you analyze the 2 companies, it seems like Deere has a little bit more of a business success rate under the hood in terms of revenues, earnings. The dividend growth is better. So we're excited about that rotation into Deere. But those are just 2 examples of how you can look within DIVO and see things that are opportunistic and taking into account what's happening in the world.
So, Kevin, for financial advisors that run their business based on model portfolios, where do you feel DIVO fits?
Yeah, it's definitely not an alt strategy that, because there's some covered calls sprinkled in, should be put off into the corner with a small allocation. This is a rising dividend core strategy. This is an equity income play. This is a portfolio with the highest quality companies. So if I was to allocate a portfolio and if I was an allocator, I would look at DIVO as a core position to build around. And I think if you haven't used it for the past 5 years, you did well. You didn't miss anything. But for the next 5 years are going to be a lot different. and the secret to DIVO in terms of its rising dividend component and its tactical use of covered calls, I think can serve your clients really, really well, especially if at some point they ever plan on retiring. And unfortunately, Jay, neither you or I can stop the clock.
No, we can't. To learn more about the Amplify ETFs, CWP Enhanced Income ETF, symbol DIVO, visit DIVOETF.com. That's DIVOETF.com. Thanks, Kevin.
Thanks for having me, Jay.